even with this OCR increase, it may not necessarily be the case that we see much change in mortgage rates.
Kia ora, and welcome to a special reactionary episode of the New Zealand Property Market Podcast, brought to you by Cotality on the 8th of July 2026. I'm Head of Research Nick Goodall, and I'm joined by our Chief Economist, Kelvin Davidson. Kelvin, we've had the hike from 2.25% to 2.5%, and the decision was a consensus. What's your first take, mate? What'd you take from the release from the Reserve Bank about an hour ago?
Yeah, I mean, like we said on Monday, we were probably leaning towards a hold, but acknowledged that an increase would not be a surprise either. So, there were strong reasons in both directions, and as it's turned out, the committee voted unanimously for that increase to 2.5%. So yeah, some people had anticipated it, some people had anticipated the hold, and it was pretty split down the middle. So, not a total surprise, but yeah, there were strong reasons to hold as well. I guess the tone of the commentary, and keep in mind it's just a review, so we don't get the full set of forecasts or anything. I think there are a couple of key aspects or justifications behind the decision to increase. One was sort of the sense that, well, even before Iran, we were planning to increase anyway, so sort of let's get on with it. That kind of had that tone to it, even though obviously fuel prices have fallen back, and maybe the risks of second round inflation have receded a little bit. They just felt, well, monetary policy is still a little bit accommodative, as people talk about. So we need to remove some of that stimulus at some point. Let's get on with it. So that sort of thing. And also they were pretty clear to note that their feeling on wider financial conditions lately, their feeling is that it's perhaps just eased a little bit more than what they wanted. So that's in the form of a lower exchange rate and also lower wholesale market interest rates. They just had a feeling that had maybe gone a little bit too far and was perhaps undoing some of the work that the Reserve Bank had wanted to see. So they felt they needed to push back on that by pushing up the OCR and potentially seeing some of those wholesale interest rates just tick back up a little bit again, and maybe see the exchange rate go up a little bit again too. So yeah, a wee bit of pushback on what's happened lately, and also I guess just a sense that they want to see that return to a more neutral official cash rate at some point. So they decided to react today. What they do next, I guess, is still the big question, but they were pretty clear to say that further OCR increases will be seen at some point, but it's just going to be how that data comes in the meantime. So yeah, no huge surprises, but there would have been strong justifications for holding as well.
I think the big surprise is that it was unanimous, that they all voted to hike. The fact that that was a change from whatever it was, only 6 or so weeks ago. But I suppose if you look into it a bit more detail, there is still a bit of a split in terms of their, fear that inflation is too high or has some upside risk they talk about. And if you look at the detail, and I suppose, like you said, it was only a review, not the full statement, but it was a much longer review than what we've seen in the past, particularly prior to Anna Bremen being the governor. And you get so much more detail about this committee member said this, and another one said this, and their risks were this. That I think we're getting a lot more transparency and insight here, where even though the vote was unanimous, you can sort of see how some fear, higher inflation or higher upside to inflation, including, I think it was Prasanna Guy and Hayley Gawley, who said there was heavily skewed to the upside for inflation, while Anna Bremen and the other three think those risks are more balanced. And so I think that, to me, shows that if you think that inflation risks are balanced, then maybe you would be siding on the thing where you go, there's no need for, or not as much need for, another OCR increase as soon. So that, when we talk about, yes, they were very clear that one of the big forms of uncertainty here is when the next increase will be, but it will be an increase. When it will come, to me, the fact that it's almost a 4-2 split in terms of where they see inflation at, that actually it should be a hold in September. It's obviously very early days, and I was just looking at the date now. It's the 2nd of September, that decision, which is literally 8 weeks away. So it's a bit longer between the decision now and then. There's a couple of important releases between now and then that I think we'll be looking at and they'll be looking at too. That includes the CPI inflation data on the 21st of July. So what's that, less than 2 weeks away now. That'll be for Q2, so for the quarter just finished. They did include an update to their expectation on that quarter data too. In the May MPS, they said inflation for Q2 was likely to be around about 4.3%. Their updated forecast for that number is down at 3.9%. So a pretty decent reduction in that expectation. It's still above the 1 to 3% band, of course, and that's part of the conversation here, right? Got to get on top of it. I know you're talking about financial conditions have eased, and they don't want that to further ease, because that could stimulate spending and stimulate that inflation rate. So I get it. But yeah, it does look like inflation is lower than what they expected only 6 or 7 weeks ago. So yes, I do think that makes me, say that if we're watching for CPI inflation, if it is around that 3.9%, and between now and that date of 2nd of September, you don't get any major concerns on second round inflation. That's where the economy gets to as well. We've got the labour market data coming on the 5th of August, so that'll be about a month before this decision, but there's a lot of detail in there, of course, with the unemployment rate at, what is happening with wage inflation, one of the key signs of second round inflation as well. So I think those are the key things to watch for between now and that date. And yeah, they've also continued to reiterate data dependent, all of that stuff. But for me, the fact that the committee members, most of them thought the risks to high side inflation are balanced, means that maybe we can expect September to be a hold, but absolutely noting there's mass uncertainty there, which did come up in the statement as well, or in the review itself. I've got a few more things on my mind, but is there anything else you want to talk about before I just keep working through a few of my notes, Kelvin?
You probably just maybe it's been coming through in the conversation, but also just, I guess, keep in mind that, and it might seem a bit abstract to people listening, but this idea of getting back to neutral. So from the Reserve Bank's perspective, where they sit right now is that we're still theoretically in accommodative territory where the OCR is low enough that it kind of is actively sort of stimulating the economy and might be sort of indirectly contributing to higher inflation than they otherwise need. So, it's not necessarily an outright tightening that they're talking about here, when they're not looking to really restrict things. It's about sort of returning to a more normal level. I guess the sort of, what's the Goldilocks thing, the sort of not too hot, not too cold, that sort of thing. So we shouldn't necessarily conclude from this that they're trying to be, real nasty and take away the punch at the party, or whatever they say, that phrase. It's kind of just getting it back to a more neutral sort of level. So keep that in mind. And I guess if people, given it's a property podcast, people are wondering about the housing market. I think, probably not a lot changes. I mean, yes, you might think that if they're right about the economic recovery coming back through, perhaps stronger than what was looking a couple of months ago, you'd think that might, even if the OCR goes up again, which looks like it will, you'd think with that stronger economic recovery, a bit more confidence, maybe some jobs growth, that could sort of see house sales tick up a bit and house prices tick up a bit, maybe. But at the same time, there's still a lot of listings out there. There's still uncertainty. We've got the election coming up, possible tax changes. That mindset just seems really cautious at the moment. So, yeah, even if we do see a bit of growth in sales and prices in the second half of the year, it's unlikely to be particularly strong. So that's just something to keep in mind. And in terms of mortgage rates, they actually said that there's still quite a spread, I guess, between prevailing market mortgage rates and sort of funding costs effectively. So, even with this OCR increase, it may not necessarily be the case that we see much change in mortgage rates. Maybe you see floating rates go up a bit, and maybe those really short fixes, but the longer term sort of 1-2 year fixed rates that people are pretty keen on at the moment may not necessarily change all that much. So we'll see, but I think that's a couple of extra things to add.
Yeah, good points. And on the housing market, they did acknowledge in the review themselves that, the housing market has, I think what they said, flattened or plateaued, despite referencing a figure that said prices had fallen 0.4% in the year to the end of May, which seems a little bit lower than, what we and others have been reporting. We've also obviously reported June already, and we've got, our home value index is down 0.9% annually at the end of June. So I think it's a bit weaker than flat, to be honest. So it does feel to me like when you put all that together, they're probably still a little bit optimistic as to where the housing market's at, its contribution, of course, to potential regrowth in the housing and the economy. Also, the economic forecast. I mean, the Kiwi GDP nowcast has got this current quarter, which, let's be honest, is only a week old, ending at 0.7% growth. Now, it's very early days, and so a lot more data is to come with that, but it does seem like it's a significant rebound on where they expect Q2 to essentially be flat. But that underperformance in Q2, they expect to bounce back in Q3. And maybe, I suppose, with the peace deal looking like it's mostly holding. I mean, there's been a little bit more doubt thrown into the works in the last day or two on that. But, if that does hold and we do see the continued hold down of oil and petrol prices that we've seen over the last few weeks, and we see that confidence flow through to reality, that confidence boost we've seen recently in like the business and consumer confidence data, then maybe that growth in the economy will become true, but it still feels a little bit optimistic to me. So I think that's maybe where it is. Like we've talked about so much in the last few weeks, it is really about how everyone's reading this data as to whether you think they should have increased or not, as to whether you sort of trust or your read or your experience in the economy and seeing these things and going, are things okay? Are things doing well? Are businesses doing all right? Are consumers actually out there spending? How are they feeling? If you don't think that's going so well and you don't think inflation is quite as bad as they expect, then you are in the hold camp. If you think that the economy is doing okay and we're going to see that growth come back and the confidence is real and all that stuff, then you're not too worried about lifting that OCR to fight against that slightly higher inflation, which is also expected to stick around a little bit longer than maybe those in the other camp feel as well. So, I think that's probably where some of the differences come in. On the uncertainty thing, I did note, and actually because there was so few of them, there was 5 references to uncertain. These statements or reviews are so much smaller than the full statements themselves, but there was 3 in April, 5 in October, 12 in July. I mean, there's very minimal, but they are a much shorter review that they put out. But what was interesting was that if you look at each of those references to uncertain, they referenced 5 individual things which are uncertain. So that includes medium-term inflation, uncertain; geopolitical conflict, uncertain; economic recovery, uncertain; neutral interest rate, which I want to talk about in a second, also uncertain; and then what you've already talked about, that further OCR increase timing. No doubt it'll come, but the timing of that increase, uncertain. So, while it's only 5 references, it's 5 individual references to 5 individual things, which just show how important it is to watch the data for the next 8 weeks as to what happens in September. On the neutral interest rate, again, there was just a really interesting couple of lines in there where it was one committee member, and I think it was Guy again. Let me just get the quote in front of me. Prasanna Guy argued that global conflict fracturing supply chains and massive defence spending, that it had shifted the neutral rate up permanently. So effectively, if the neutral rate previously was 3%, where, as you said, the OCR itself, monetary policy, is not stimulating the economy, but also not slowing it down, if that's now lifted permanently because we've had these big shocks that these interest rates are going to be higher, does that mean that the chances of sort of ultra low interest rates staying super low or are super low to get there again, unless there's another fundamental shock, of course, which goes the other way or maybe pushes it further. But I think there's some consideration there because there does seem to be that uncertainty as to what is that neutral rate, 3%, 3.25, maybe it's even higher than that. If, the global economy and the way we operate globally now with supply chains and what's Trump done with putting, higher cost on getting goods from overseas, like that sort of stuff, if that's embedded and that changes dramatically, then maybe those interest rates will just naturally be higher over the longer term anyway. So, I just thought there was a couple of interesting, other things in there that we probably haven't talked about in the past that were brought up through the review. I don't know, does that spring any further thoughts, Kelvin? Anything else on your mind?
I guess just around the neutral interest rate, there's definitely not an exact science around that. Economists will have incredibly in-depth models to try and estimate what that is, but I guess it's never fixed through time either, and it can be a wee bit subjective, and it just depends on sort of what's going on at the time, as well as I guess these bigger fundamental things. And I mean, if I guess effectively what all that's saying is that maybe there's just higher risk in the system now, and to account for that extra uncertainty, that extra risk, which might mean inflation or sort of structural inflation has gone up a little bit. Perhaps you need a structurally higher neutral interest rate, which I think is kind of the logic flowing through all of that. So, that's something to keep in mind. But is it a definite target, an exact science? Probably not. but it does whatever it is. The number here, where a neutral official cash rate is, it's certainly higher than where it is now. What the actual rate is now at 2.5. So, that just feeds into this idea that we are looking at medium term official cash rate increases. Just a matter of when, I suppose, in that timing. And as they said in the statement, that timing is highly uncertain. But it's about watching the data between now and early September, and just seeing what sort of flows in, and what the way that people might interpret that.
Yeah, no, great point. Much better said than my, ramble before, which didn't really go anywhere. But that's exactly the point, right? No matter where that neutral rate is, we are at 2.5%. It's still stimulatory, so it's still accommodative for people borrowing and spending, but it's because of the other factors that are holding that back. So, yeah, it's going to track upwards. Timing is massively uncertain. All right, mate. Well, I think that's pretty much us for today. Before I do a full closeout, I just want to put one more thing to you. I'm going to give you their final line, and then, what can people watch for? So here's their final line, which I think summarizes the situation best. Future OCR decisions will depend on the committee's judgment about how price-setting behaviour and excess productive capacity affect medium-term inflation pressure. Now, that is, what everyone's watching for. So just, between now and that September decision, if people wanted to get a judgment on how the Reserve Bank might, see their decision-making change in the next 8 weeks, or set up for that 2nd of September decision, what price-setting behaviour are we watching for? What surveys, what data, what releases are we watching for between now and then? If you want to give that final few words, mate, and then I'll close us up and get us out of here.
Yeah, so the things you've mentioned already, we've got the CPI itself, which is obviously a biggie, and we've got those labour market figures. So the CPI itself is obviously going to be important, but also what's going on in the labour market numbers in terms of wage growth. Has the unemployment rate come down a little bit, which might signal further wage growth, and perhaps some signs of second round inflation? Those will be important, but also monthly surveys. The Stats New Zealand puts out these selected price indexes measures. ANZ Business Confidence Survey is an important one in terms of, because they provide kind of labour market indicators. Are people asking for higher wages? What are firms thinking about in terms of the wages they might have to pay? So those things will all be important. The Reserve Bank has its own sort of internal measures, I guess, of forward-looking inflation, which they'll be watching too. I'm not entirely sure of the publication schedule for those numbers. It might only be quarterly, so whether we get one in the next 2 months, I'm not sure. But yeah, there are a lot of things to watch. It's still all about prices. The RBNZ obviously has one policy target, and that's the Consumer Prices Index. So anything around that will be very important, and we've actually got quite a few coming out, so there will be a lot of data to watch.
Yeah, no, brilliant, mate. Well, I think we can leave it there. No doubt it is continued intriguing times. But yeah, brilliant, mate. Thank you very much for your time, Kelvin. And thank you all very much for listening. Please do make sure you subscribe to the show, and feel free to get in touch too. I'm always keen to hear your take on it, maybe your read on it. Did you see something we didn't? Or if we got something, our read on it slightly different, let us know. Just leave me to say thanks once again. My name is Nick. He's Kelvin. You've been listening to New Zealand Property Market Podcast. Mā te wā.